The US government has a humongous debt of $30 trillion. That is a big amount of debt to own. Now, the thing is that currently the US economy is trying to fight inflation. One of the methods of fighting inflation is by raising interest rate. But when you raise interest rate, this will increase the amount of money that you need to return on your debt. So this could cause an increase of $1 billion of money that you need to return on the US debt. The US is trying to fight the inflation with other methods such as quantitative tightening. It's currently decreasing. It's removing $47.5 billion each month. And then after 3 months, it would do a quantitative tightening of $95 billion per month. Usually, when we have quantitative easing, meaning we release money to the market, then the stock market goes higher. And indeed, since 2008, after the crash, when the government has released so much money into the market, the stock market and asset prices got skyrocketed. If you don't see these amounts of money in your pocket, you don't see them with you, that's okay, because this amount of money is getting to the rich people, to the ones who are accumulating assets, the ones who had assets, and the asset prices are increasing. In fact, the asset prices are inflating by the quantitative easing money that is being released to the market. But now that we are going to have a quantitative tightening with a combination of interest rate getting higher, then we should expect the stock market not to skyrocket. We could possibly expect something different when we decrease the amount of money. If we're going to continue to decrease the amount of money, if we are going to continue to increase the interest rate, then I don't see the stock market getting higher, except for specific stocks. Because if you are a growth stock of a company that does not make any money, then yes, with quantitative tightening and with interest rates getting higher, then I don't expect your stock to get higher. But if you are a company that has a leverage over the prices, that you can increase the prices of the product that you sell as the interest rate gets higher and the inflation gets higher, then you have a leverage. Then your stock could get higher, actually. This also depends on your inputs. If the inputs to your company, because each company has an input and an output. The company takes something as an input and produces something, hopefully, as an output. So if both the input and the output prices are getting higher, then we are in a zero-sum game. We could also be in a negative game, so the stock price could not get higher. But if the input price increase is less than the leverage that you have as a company on the output price increase, then it's possible that your stock would get higher. If you're a stock that pays dividends, then people would also prefer this kind of stock to a growth stock. So in this kind of shaky environment, people tend to move from growth stock. We've seen this in the ARK ETF, where people move their money from growth stock, from companies that are more like bets. They do not have any revenues as of today. They are not profitable, into more stable companies, money-making machines, Coca-Cola-like, and things that their input costs do not get really higher. The more that the input cost is not getting that drastically higher with reference to the output cost, then these companies are the better ones during inflation. Also, gold and silver, which are fully detached from the stock market, and real assets, such as housing and similar, those are the assets that tend to perform a little bit better, for sure, than the stock market under an inflationary environment. I want to add just that this is not a financial advice. This is only my opinion. Do your own calculations and take into account that everything is risky.